Well, g'day there, traders and friends, market enthusiasts right around the world. This is James on behalf of Pivot Point Trading. What I've done, I've just finished that pro analysis class dated Saturday, the 27th of February 2016. It is up online at our website, pivotpoint-trading.com. In this week, a little bit special. Not only did I analyze the top 3 US markets, so the Dow, the S&P, the NASDAQ, and also our top 12 individual trade lists, I went a little bit further into the detail and spoke about really 3 doors or 3 investment vehicles which people can soon take at certain levels on these markets, which is going to open up a world of opportunity for people when this market rolls. Specifically, I went through some leveraged ETFs, non-leveraged ETF, and some option plays with the strikes, and of course the expiration months, which I'm personally looking at and are starting to open given the structural sort of discrepancies we're seeing with markets or counter market imbalances which are occurring, and some of these major back tests which are happening, say for instance on the Russell and the Dow Jones Transportational Average, which is all leading to, again, an inevitable sort of little dead cat bounce, so to speak, or a little correctional move back into the primary trend, which is going to upset a lot of people who do not hedge accordingly whenever it is and what location it is, possibly somewhere between 17,000, 17,250. This red box in my screen is really the red zone of where a reversal should and will take place, but definitely below 17,550. And I just spoke about some opportunities of again, what I'm doing and what you can do to take advantage of this roll, because once this roll happens, and if this roll does happen at this location, you can bet that this support level down here at 15.5 is getting taken out. In fact, what I also did over the weekend was bring up the S&P500, and we came to the conclusion very easily that before June, July 2016, the S&P500 should and will be trading at about 1,950 points. If the S&P comes on up to 1,500 points. If the S&P comes up to 2,000, you're looking at a 25% write-off on that particular indice. And then we opened up, of course, some of those doors to investment vehicles and opportunities for people to take advantage of. And when you talk about options and leverage, when you're talking about a potential move, say, for instance, on the S&P from 2,000 all the way down to 1,500, let me just show you this, because you might be saying, well, where did you get 1,500 from? If I take the annotations off my screen very quickly for you, if I zoom out to both 2000 and 2008, you can see over here, if I just very simply draw a red line across the screen, in both of these instances, when we've come down to about 1,500 on the S&P, this was resistance once, this was resistance twice, and obviously once we break above it, the dynamics change, supply and demand change. And if we crack below this level over here, this is at bare minimum where this correction is going to move to. Well, there's a very, very good chance that this will act as new support. And that puts us in, once again, more or less right around that 1,500 level. It may be 1,530, I'm not too sure, but generally markets gravitate to psychological round numbers. That's why I'm rounding it down a little bit further to 1,500. Again, the S&P 500, it closed at 1,948. And again, if this is the bullish bounce, which I've been spot on with and throughout the entirety of this sort of transitional bull bear market, which we've been through since late 2014 into the beginning of 2016, this little rally which we've seen, this little 2 to 3 week rally off from the lows, which I spoke about on this particular candlestick over here, it is going to turn, it is going to reverse. You need to find that sweet spot, so to speak of. And then not only do you need to know where the tipping point is and how to understand just when the market is telling you that it's ripe to turn, you need opportunities and, again, vehicles to put some capital into to at least hedge at anything, at a bare minimum, just to hedge your open exposure. If you don't have, a big enough conviction to at least expect or at least think that a market could potentially drop as much as what I just referenced. Now, 1,500 is a very conservative target. I am going to put that out there. The reason why it is conservative, and am I on the S&P 500? Yes, I am. I just finished pro. The reason why it's so conservative is because if this support level cracks over here, it's really the next support level, the next macro support level. If I change to the monthly chart, there's nothing holding this market up above the highs of 1,500. Once we broke above these highs, it's been off to the races. Again, liquidity-infused bull market rally, optimism, whatever it is you want to call it. And we haven't looked back until, towards the end of 2014, the transitory market we saw in 2015, the breakdown in August of 2015, and these two consecutive dead cat bounces, what we call slope of hopes in technical analysis, with the final one about to exhaust itself. This is it. There are going to be no more opportunities if this dead cat bounce, which I'm calling, fails. If this dead cat bounce fails, these lows, you're going to wish that you had that, you potentially sold out, or you sold out at, and you're going to wish in retrospect that, hey, I should have had a hedge, or I should have, thought about these different types of options to take on, because this is the best price that you're going to get on these markets for a number of years. And again, I'm not here to alarm anyone. It's just the reality of what we're working with, both fundamentally, but more so technically as well. I mean, bad things happen. Bad things happen when we remain below the 100 and the 200. We put in these macro lows and these consecutive lower highs, and we see these huge transitory shifts and chart topping reversal patterns as well. I mean, it's not a good thing. So it's just, I mean, there's nothing really more that I can do for you if you're listening to this recording and you don't go down that path. That's fine, but just don't be shocked when you see this market again cracking below macro support in maybe 2 months' time. Whenever this dead cat bounce fizzles, you'll see how all of this unwinds. But outside of that, I wish everyone a nice weekend, a fantastic weekend. And if you are trying to make sense of what is just going on in the financial markets, I would encourage you to sign up to Pro. Have a look at that Pro class. It's online. It's up there indefinitely. It will most likely be up there for at least 2 to 3 months, as with our back catalog. And it is up online now, housed on the site at pivotpoint-trading.com. All the best, everyone. If not, just have a look past the two or three other videos I've posted this week, and you'll get a very good understanding of what we're looking at and just how we can determine these levels to a very high degree of probability, and the tipping points, the pivot points at where these transitions and these turns take place. If you can work that out, really financial markets open up and they become a lot simpler to interpret through technical analysis, and you'll learn that in that analysis class again. So all the best, everyone. Have a fantastic weekend. I'll be back with you next weekend or next week for some more market updates. But in the event that the market doesn't do anything all that miraculous or spectacular, will be next week in that pro analysis class. All the best, everyone. Have a fantastic weekend. Goodbye.